Hello students and welcome to this explanation. We are still busy with IAS 33, which is the earnings per share. And this is a very nice question that we have here because it combines all the types of earnings per share. So if we just quickly scroll to the required part, you will find that this asks for a calculation of the basic earnings per share, diluted earnings per share, and the headline earnings per share. So this is quite the comprehensive question to ensure that you understand the principles as it relates to all of these types of calculations. So I want us to read together, and I'm not sure how to pronounce the name of this company, but let's call it Boabab. And it says this entity has a year end of 31st December 2006. It says that in the first note, the entity declared and paid an ordinary dividend of 100,000 Rand in the current year. In the previous year, 80,000. A preference dividend of 120,000. In the previous year, it was also 120,000. Then they've given the tax for both years, 320,000 and 210. Then the profit for the period after they've deducted the tax was 1,450,000 and 1 million in 2005. In the second note, they say on 1 January 2006, the issued share capital for Boabab consisted of 2 million ordinary shares and 1 million 12% cumulative preference shares. On 1 September 2006, 100,000 11% convertible debentures of 2 Rand each were issued. The debentures are convertible into ordinary shares on the 31st of August 2008 at a price of 5 Rand per share at the option of Boabab. Assume that similar debentures carry interest at 10% per annum in the current marketplace. If they are not converted, they being the debentures, it is then redeemed. On the fourth note, they talk about share options. On the 31st of March 2006, 200,000 share options were granted to employees. The options entail the right to purchase ordinary shares on or before the 31st of March 2010 at 2 Rand 50 for every share option held. The average market price of ordinary shares for 2006 is 4 Rand per share. Then note number 5 says that they had a rights issue on the 30th of April for 1 ordinary share for every 5 shares held at 3 Rand per share. Again, the market value before the rights issue was, or the fair value before the rights issue was 4 Rand per share. On the 31st of October 2006, there was a capitalization issue for 1 ordinary share for every 100 shares held. In note number 7, they've given us a number of items as it relates to headline earnings. So you will recall that in terms of headline earnings, there are certain items that are included and there are certain items that are excluded. So the gain on sale of vehicles definitely excluded, so we have to go and basically deduct it. Then the impairment loss on goodwill definitely excluded, so it needs to be added back. Depreciation is included, so nothing needs to be done with that item. Loss on sale of equipment will definitely be added back. It's an excluded item for headline earnings. However, it is 0 in the required year in 2006. And then they've also given us pension fund costs, which are of course included, and we will then not include that or basically add back that item when we calculate headline earnings. In the 8th note, they say that the normal tax rate is 30%. And for the year ended 31st December 2006, we need to calculate the basic earnings per share, the diluted earnings per share, the headline earnings per share, and we are instructed to ignore comparatives. At this stage, something that bothers me about this question is that there are no rounding instructions. So, of course, in a test, I am going to give you proper rounding instructions because you will find with calculation of earnings, the rounding can make quite a big difference. So that's something to look out for. So I would just like to add, I wonder if we can add it to the same page. Here, it seems not, but let's assume then for the rounding that all Rand values are rounded to 2 decimal places, and then the shares are rounded to the nearest whole share. Right, so that's it, so that we can all just be on the same page regarding the calculations. Something that comes up, and it's just a question that I would like to answer before we start with the memorandum, is that students often ask, but ma'am, how will I know whether an item is dilutive or whether an item is a weighted average number of share item, right? Because if I look at the notes, there are quite a bit of things going on, and now we need to categorize. We need to know, for example, if I look at note 3, that's going to influence my dilutive calculation and my dilutive earnings per share. But if I look at number 4, that will influence my dilutive earnings per share as well. But if I look at the rights issue, that's going to influence my weighted average number of shares. So how do I know which goes where? And how do I identify an item so that I can correctly categorize it between the VANOS versus the dilutive calculations? And for that, I'm going to answer it as follows. So what we need to do is we need to go and determine what is basically the stance of the item. So there's basically 2 options. One is that it can affect your weighted average number of shares. The other option is that it is dilutive in nature. So how will we know that an item is dilutive and it needs to form part of your diluted earnings per share calculation? Well, it's simple. You need to look at the instrument, right? And if you look at the instrument, the trick is to pay attention to the fact that it is not currently ordinary shares, right? But it has the potential to become ordinary shares. So if we, for example, look at the note where they talk about the debentures, for example, the debentures are currently not ordinary shares, but they have the potential to become ordinary shares by 31st of August 2008. So the item currently is not an ordinary share, but it can become an ordinary share. And in that instance, it's a dilutive instrument. Then if we go back and look at the items that affect your weighted average number of shares, it's already ordinary shares. It will just affect the volume, for example, and the potential. So let's explore that. If we look at, for example, the capitalization issue. So there's already ordinary shares, and the capitalization issue just gives you more shares for the ordinary shares that are available. Same with share splits. It's already an ordinary share. They're just splitting it into more ordinary shares. Also with the rights issue, they are issuing ordinary shares, but they're just issuing it at a cheaper price. So the potential changes where it would have cost 4 Rand, now it's costing 3 Rand. So it's already ordinary shares, but something kind of snaggy or tricky is happening with it. So that's the difference between whether an item is part of your weighted average number of shares or your dilutive. If it's dilutive, it's not an ordinary share yet, but it can become an ordinary share. Whereas with the items that affect the weighted average number of shares, it's already ordinary shares, but there's some kind of trick leading to more ordinary shares or leading to cheaper ordinary shares, but it's already ordinary shares. There's no other instrument attached to it, like a preference share or a debenture or a share option. So that's how you would typically know the difference. Moving on to the memo, I've just typed a layout so that this video isn't like 5 hours long. And I want us to start with the basic earnings per share, which is required number A. And then we need to calculate the weighted average number of shares and the basic earnings. So I'm going to start with the weighted average number of shares, and the opening balance is given to us as 2 million ordinary shares at the beginning of the year. Then there is a rights issue, and following that there's a capitalization issue. As always, there's a number of steps you need to apply when you are busy with your rights issue, and there will be two elements to the rights issue. There's bonus shares and there's fair value shares. So let's explore that, and I'm just going to do the calculation here on my right hand side so that I don't have to scroll up and down, so that you can see where the amounts come from when I type it into the weighted average number of share calculation. So the first step is that we need to calculate the average value of a share when we are busy with a rights issue. And here I split it into two, I want to say, types of shares, and I call it old shares and new shares. And there's no rule. I mean, you can just call it shares before the rights issue, shares issued as part of the rights issue, because that's what it means. So old shares are the shares that are already issued by the time that the rights that were already issued by the time that the rights issue is undertaken. The new shares will be the shares that are issued due to the rights issue. So immediately before the rights issue, we have 2 million shares, and those have a fair value that are attached to them of 4 Rand. Then the new shares, if we look at the rights issue, they say 1 ordinary share for every 5 ordinary shares held. So here we're going to say, what do they already hold? 2 million. And we get 1 for every 5. So for every 5 we get another 1. Then I'm just going to add this together so long so that we have the number of shares. The value that is attached to the new issuance is now cheaper, and I believe the rights issue is done at 3 Rand per share. And to get to the total Rand value, I just multiply the total shares by the value per share attached to it. Then, of course, I also get to the total value of the Rand, or in Rand terms, and now I need to go and divide. And when I divide the 9.2 by the 2.4, I get 3 Rand and 83 cents. So I'm just retyping it so that Excel doesn't carry any roundings, and that the answer on this memo will be the same one as the answer on your calculator when you do it by hand. Then we are on the second step where we need to calculate the fair value shares. So what we need to understand about the rights issue is then the following. So when we have a rights issue, we have a situation where the shares were issued but not for free, right? So we have two things that's happening. We have fair value shares, which are the shares paid for. And then we have the bonus shares, which are the shares that we got for free due to it being cheaper, because it should have been 4 Rand, and now that we only paid 3 Rand. So basically we scored some bonus shares, because under normal circumstances we would not have been able to obtain these bonus shares. We would have paid we would have gotten what we paid for. So there are two elements to this. So the fair value shares and the bonus shares, and I always like to calculate the fair value shares first and then the bonus shares based on the number of fair value shares. So how do we get to the fair value shares? Well, we argue that we take the Rand value of the new issuance, which is the 1.2 million, and we divide it by the answer in step 1. So we're going to say 1.2 million divided by the 3,83. And when I do that calculation, I get an answer of 3,13316 if I round to the nearest whole number of shares. Then we need to go and calculate our bonus element, or our bonus shares if you wish. And for the bonus element, we have new shares minus step 2. So there's 400,000 shares, I beg your pardon, that were issued altogether. We paid for 313,316 of them, so the difference would now have been what I've scored, my bonus element. So that's 400 minus the 313,316, and then the answer here will then be equal to the 400 minus the fair value shares. And I'm just going to put the answer in yellow. So for the bonus, I'm already going to go and just fill it out. If it is calculations for the current year, or the rights issue was done during the current year, the bonus amount is taken as is. If it's for the previous year, it needs to be weighed out. So it's 86684. Then for the fair value part, we need to go and adapt it to the number of months for which it were issued. And if I look at the number of months from this question, they said the rights issue happened in April, on 30 April. So we were left with May, June, July, August, September, October, November, and December. We were left with 8 months in that year. So I'm going to take this times 8 out of 12, and that gives us 208,877. So I'm just going to type it again so that the rounding is the same as you would have by hand when you do your calculation on your calculator. At this point, I'm just going to get a rollover total. So I'm going to put it in bold, and the total then up till this point would be the opening and then the bonus and the fair value shares. Later that year, we have a capitalization issue, which also affects the weighted average number of shares, because there are already ordinary shares and then they're giving you more shares due to having ordinary shares. And in the capitalization issue, we are told that there's 1 ordinary share for every 100 held. So for the capitalization issue, we're going to argue, well, the rollover total up till now is 2295561. Then we're going to divide that by 100, and we get 1 for every 100. That is then 22956. And thereafter, we can calculate our closing balance, which is the previous rolling total, adding the capitalization issue. And the closing balance for the weighted average number of shares is 2318517. Right, we are then moving to profit for the year and the preference dividend so that we can get to basic earnings. The profit was given. If I look at the profit in the current year, they say it's 1450000, and then there was a preference dividend of 120,000, which I need to minus. And if I minus it, the total basic earnings is 1330000. From that point forward, I just need to bring over my weighted average number of shares as I've calculated them. And the basic earnings per share will then be the basic earning total divided by the weighted number of shares. And I get my basic earnings to be 57 cents, 0.57, which is then the basic earnings per share for Boabab Limited. Right, very interesting question. And yeah, going forward, let's see what we can do with regards to number B. So for number B, they've asked us to calculate the dilution. So that's the diluted earnings per share. And again, I've just set up my headings so that we can start with that part as well. There are 2 steps when we calculate diluted earnings per share. The first step is that the instruments, the dilutive instruments, need to be ranked, and thereafter they need to be tested for their dilutive potential. So we're going to start with the first dilutive instrument, and I believe that was some debentures, right? And for the debentures, we had to go and do a calculation. And they tell us that it is, I'm just going to quickly go back to the question. They tell us that there's 100,000 of these convertible debentures at 11%. They carry 11%. They're worth R2 each. Then the debentures are convertible into ordinary shares and at R5 per share. Then assume that similar debentures carry an interest rate of 10%. So now we are dealing with a yield to maturity here because debentures represent a yield to maturity because we're waiting for the time to pass. And once the time has passed, we are either going to give them shares or we're going to redeem it by giving them money. So in approaching this calculation, the basic assumption is always that money will be given until it is clear whether they're going to take up the shares. So going back, we're going to say we need a fair value or a future value, I beg your pardon, and the future value will be the R2 times 100,000 shares or 100,000 debentures. Then we need a time period, an N. So on your calculator, you're going to type that the N is how much time. So it is issued in September of 2006 and it's redeemable in August 2008. So that would give you 2 years because the first year will end August 2007, the second year will end August 2008. So the time period, 2 years. The I, we always need to use the market-related I, which is given as 10%. Then we need to go and look at the payment. And the payment will be our future value, which is the 200,000, times the payment, which is we pay them 11% in our business when we issue these debentures. Thereafter, we need to go and calculate a present value on our calculators. So when I calculate a present value from this information, I get to an answer 203,471. I just quickly want to check the decimals and make sure that they are correct. I don't want to just trust a memo. And here we get 7 cents. So it's 203,471 and 7 cents. Now I also have to go and explore what the interest will be in this for this calculation. So the interest will be, there's an amort 1, right? So amort 1 will be up until, or it will be between the 1 September 2006 to 31st of August 2007. That's the time period for amort 1 on your calculator because the years run differently for the debenture issuance. So if I go to amort 1, the interest that I see there on my calculator is 23,471 and 11 cents. But we need to be careful now because the whole period does not fall within our financial year ending 31st December. So the interest up until 31st December 2006, which is our year end, we need to go and adjust it. And I believe it's then September, October, November, December. We need to adjust it for 4 months because 4 months will fall within our current financial year. So I'm going to take the 20,347 and 11 cents, and I'm going to say times 4 out of 12. Then we also need to remember the tax element because this interest is calculated before tax. So we need to go and make sure that we adjust it. And they say the tax rate is 30%. So after tax, 70% of this amount will remain. So I'm going to take the 4 months of interest and times it by 70%, which gives me 4747 and 66 cents. So for my debentures, I'm going to have an increase of 4747 and 66 cents. What will be the increase in the ordinary shares? Well, they say that it is 5 Rand per share. If we go back to the question, they say it can be converted into ordinary shares at 5 Rand per share at the option of Boabab. So the total value that we have to pay is 200,000 in future. But if they opt to get shares, it's going to be 200,000 divided by 5 Rand per ordinary share. So here we're going to say it's the 200,000 that we would pay them divided by 5. So if they take up shares at 5 Rand, we will give them 40,000 shares. Then, of course, we're going to do a division, taking the increase in the earnings divided by the increase in the ordinary shares, and that gives us 0,1186915. Normally, in doing the ranking, irrelevant of what the question says, I like to at least use 4 decimals in calculating the ranking when I do the division, just to check, because sometimes it's 0,117, 0,118, so that we can just rank them very, very precisely. Moving along to the next item that can potentially be a dilutive or have a dilutive element, and that is our share option. Right, so please remember, for share options, there's never, the increase in the earnings is always 0, because when we have a share option, we take up a share, and the amount that is then paid for or taken up for will be a capital. It will not affect your earnings. So if you have a share option, it's always increase in earnings is always 0. Right, then we have now a situation where they say, with regards to the share options, the options entail the right to purchase ordinary shares at 2.50 Rand for every option held, and then the price is 4 Rand. So again, we have a situation now where there is a bonus element, because you get to take a share up for cheaper than it is. It should be 4 Rand. Now, what we want to list here in the increase in ordinary shares is basically the bonus element to the share options. That's what needs to be listed here. So if I go back to my paint, or let's just open another paint, let's just quickly explore what this means. So if we have now a share option, you will agree with me that we again have a situation where there is a portion that's paid for and that there is a portion which is bonus. So what we paid is 2.50 Rand. So what is the percentage that we paid? We paid 2.50 Rand out of a possible 4 Rand. And if I do that calculation, we basically paid for 62.5% of the share of the shares, or the share options that become shares, which means the bonus element now needs to be the remaining percentage. So I'm going to say it's 100% minus the 62.5, which we paid for, means the percentage that we have gotten for free is 37.5%. That was our bonus element. And 37.5% of what? Well, they say that there are 200,000 options that can become shares. Thus, we're going to say 200,000 times 37.5%, and that will be our bonus element. So of the share options, or shares, because every option is the potential to take up a share, I get 75,000 options / shares that were given to me just as a bonus. So this is how we argue out the share options. There's a portion that is paid for, and then there's again a bonus element. we go and calculate what is the percentage that was paid for, 62.5. That means the bonus element needs to be the remaining 37.5, and this 37.5 is then multiplied by the share options so that we can get the bonus element to the shares. So going back, we're just going to type it in, 75, and then obviously the answer here is 0, because anything 0 divided by anything will remain 0. So the rank will be from lowest to highest. So the first rank will be the share options, and the second rank will be the debentures. Now that we've ranked them, we need to go and apply our second step where we now use the ranking, and here we need to go and test for dilutiveness. When we test for dilutiveness, we start with I just quickly want to type my layout. We start with our basic earnings per share information. So what were the basic earnings? If I go back, it was 133,000. What were the ordinary shares relating to? It was the VANOS, the weighted average number of shares, and that was this amount. So let's see if it's going to work if we say equals that. So our basic earnings per share was again the earnings divided by the weighted average number of shares, and it was 0.5736. So again, in this portion of my calculation, I normally use about 4 decimals, irrelevant of what the question says, just to make sure I do the dilutive testing correctly and precisely. Okay, so the first rank that we need to go and test were the share options. And for the share options, the earnings was always 0, and the bonus element was 75,000 shares. So now we're going to get a rollover total, which is then this earnings plus the additional earnings and the weighted average number of shares, adding the bonus element. And our new calculation then gives us 0.555. So we can see it's lesser than the basic earnings per share, and thus I'm going to say it's dilutive. Righto. Then the next one we need to test, which was the second ranking with the debentures, and the earnings there when we take the tax into account was 4,747 and 66 cents. Then the issuance would have been 40,000 ordinary shares. And now I am going to just get a rollover total again to test for the dilutiveness. So it's the previous total and adding the debenture total, same with the shares. I'm going to take then the new total in rand or earnings divided by the weighted average number of shares, and I get 0.54. So again, this is dilutive. So in calculating then my dilutive earnings per share, I'm going to use the last sub or rollover total where I found it to be dilutive. So the last rollover total which was dilutive was this rollover total. So we're going to say dilutive earnings then equals this rollover total of earnings, and then the dilutive number of shares, if I can ever spell correctly, was this number of shares, and then the dilutive EPS is then this last amount that were calculated. If there were to be an anti-dilutive, I would just ignore it and just take the last dilutive subtotal line item. And I'm just rounding it to 2 decimal places. So the dilutive earnings per share, 0.55. So it's 55 cents per share. Right, great. So far, so good. We've done our basic earnings. We've done our dilutive earnings. Now we need to move on to the headline earnings. So for headline earnings, we are again going to start with the basic earnings. Let me just put this in the correct aerial so that you can see properly. Right, so we are on headline earnings, and that's C. For headline earnings, we're going to start with basic earnings. And we are doing calculations for 2006 still. And the basic earnings, I believe, was 1,330,000. Now we need to go and adapt it according to the note, where there are certain items that need to be included and excluded from the profit. So the gain on vehicles and the impairment loss should form part of this calculation. The depreciation not. The loss on sale should, but it doesn't apply to the year that we have to calculate for. And then the pension fund should again be ignored. So in adapting or doing the headline earnings, we're going to say there's a gain on sale of vehicles. And there it will be the 63,000 times 70%. So I'm just going to type everything, and then we will get to the totals in this column. Then there's an impairment loss. And that was a total of 25,000. So it's going to be 25,000 at 70%. Then we have the loss on equipment, which should be included, but it doesn't apply to 2006. So we basically have these two items. 63 at 70%, and now we need to go and determine, should this now be added or should this be subtracted? Well, gain on sale of vehicles would have been added when I calculated my profit, so now I need to do the opposite, so I will have to subtract it. So it's minus. The impairment on the goodwill, well, the impairment would have been an expense. So when I calculated the impairment and I put it in my statement of profit or loss and other comprehensive income, I would have deducted it. So now I'm going to do the opposite by adding it back. And that's going to lead to my headline earnings. The headline earnings then for including these items or taking these items out is 1,303,400. I'm going to go back to my weighted average number of shares. So let's just go and find the correct answer there. So the headline EPS is this total of headline earnings divided by my weighted average number of shares. And the headline earnings per share is 56 cents. All right, so this was the calculation of basic earnings, diluted earnings per share, and headline earnings per share. This is a very nice, comprehensive type of question. It makes sure you know which elements are dilutive, which goes to weighted average number of shares. How do we know an item should be taken out when calculating headline earnings? So there's a lot of things going on in this question. I think it's very interesting. And I want to go so far as to say, if you understand the principles of this question, I think you understand IAS 33. All right, I hope that you've enjoyed this video, and I will then see you in our next class.